If you are waiting to invest because you don't earn enough, you could be making a big mistake. What if investing is just like getting in shape?
This is a marathon. It's not a sprint when it comes to investing.
But you don't run a marathon on your first day out, and you don't start with the heaviest weight first. You start small, get used to it, and go from there. And just like working out, it's about building good habits. We talked to 2020 millennials about how they invest. Many of them told us they don't. Why? Because they're waiting to earn more first. But you can't wait until you're strong enough to lift the big weights, right?
I would say you always have enough money to invest.
Well, it's never been cheaper to start small with investing. And missing out on time in the market is not something you can make up for later. Over 40% of millennials from the ages of 23 to 38 haven't ever put part of their paycheck into financial products. Exactly half of those non-investors said they might start when they earn more. And they had some other reasons for not investing too, like focusing on savings, or just not understanding how to do it. But you don't need to be an expert to start a portfolio. Most millennials we surveyed have been investing fewer than 5 years.
Using an app or some sort of robo-advisor site is a really easy way to get started.
Most are using simple, no-fee trading apps. Just $10 or maybe even less is enough to build a diverse portfolio on some of the best investment platforms out there. Thinking you need to be rich to start investing is a myth. About a quarter of millennials set aside less than $100 per month, and more than half put less than $500 into the market.
$100 a paycheck is much better starting off in that capacity in terms of investing to allow that money to grow over time than it is to say, I'll do absolutely nothing and only think about the short term.
It may not seem like it, but now is actually the best time to start investing, no matter when now is. Even in this now, the coronavirus pandemic has not changed people's long-term outlook. Over half of millennials are sticking to their pre-pandemic strategies.
Investing really should be a long-term game. You want to be thinking at least 5 to 10 years down the line.
Whether you dream of retiring comfortably at 65 or quitting work to travel the world in your 30s, the simple truth is that the earlier you start investing, the easier it will be to reach your goals. Your investments won't always be heading straight up. They'll dip sometimes, but over the long term, the stock market tends to go up. Even though research shows investing lump sums of money can be more lucrative, most people don't have the ability or confidence to do that. Small amounts of money, even $10 at a time, is better than nothing, as long as you're consistent. That strategy is called dollar cost averaging.
Dollar cost averaging is essentially putting in the same amount of money at a regular interval. And so it could be, every 2 weeks you're putting money, taking money from your paycheck and investing in your 401k.
Think of it like taking a walk every day versus working out really hard once or twice a week. Both are good choices, but one is probably more attainable than the other. Whatever amount you have to invest, it can be scary to think of pouring it all in at once. And that's okay. Habits start small and momentum builds. Just because you can't bench your body weight on day one doesn't mean you shouldn't start at all.
What industries are really rising as a result of this pandemic? Is this an opportunity to think about investments that are going to be more profound in those particular industries?
The millennial investors we heard from are putting their money into healthcare, IT, and energy. They are avoiding real estate investments. The bottom line is, millennials tend to think investing is harder than it is, and that they can't afford it. But that's just not true. You've got more to lose by not starting today.